On October 6, 2025, Bitcoin reached an all-time high of $126,000, a peak validating years of optimistic forecasting. But by March 2026, the market was navigating a punishing 46% correction, with prices retracing into a critical support zone between $68,000 and $72,000. This decline created a profound disconnect. Historically, the ultimate price peak wasn't expected until late 2026, yet the market reached its summit an entire year early. The 4-year halving cycle, the predictable metronome that governed Bitcoin, failed to predict this timeline acceleration. For those still following the old algorithmic map, 2026 has become a sobering reality check. Relying on outdated timing models is proving to be an expensive strategy. Market observers are now viewing this transition through two very different lenses. The cycle believer maintains that the underlying protocol still dictates the trend. They argue the halving, the programmed 50% cut in new supply, remains the primary engine of long-term value. The new era realist counters that the asset has structurally altered. They believe Wall Street ETFs and global macroeconomic liquidity have superseded the influence of mining rewards. Retail investors are caught in the middle, attempting to trade a decentralized protocol that is increasingly behaving like a traditional financial asset. To find the true driver of Bitcoin's price in 2026, we must look past the sentiment and analyze the mechanics of the market. The realist's case begins with the observation that the 2024-2026 cycle has deviated from every historical script, a pattern known as a left-translated cycle. Historically, cycles peaked symmetrically post-halving, but U.S. spot ETFs shifted this peak left. Institutional demand front-ran the supply shock, hitting record highs early in October 2025, triggering a sooner correction to today's support zone. This downturn is the direct mechanical result. The market is effectively digesting those early gains. Institutional demand was so efficient that it preempted the algorithmic supply shock. For the first time, the speed of capital moved faster than the code. This leads to a more controversial argument that the halving itself is becoming a secondary factor in price discovery. This chart shows percentage gains between peaks. In 2013, returns exceeded 5,000%. By 2017, they dropped to 1,300%. Recently, that shrank to 120%. The descending trendline illustrates the law of diminishing returns. Each successive halving produces a smaller impact. When Bitcoin was a $10 billion asset, a 50% cut in new supply created a massive imbalance. But today, with a $1 trillion market cap and most Bitcoin mined, daily issuance reduction is just a minor ripple in a massive global liquidity pool. Relying on the halving code to trigger a massive surge in a mature market is a mathematical stretch. The asset has simply grown too large for small supply tweaks to drive the price. The believer views these shrinking returns as a sign of progress. They argue the market has traded away its extreme volatility for a more stable foundation. In previous bear markets, 80% crashes were the standard. In 2026, we are seeing the market defend price levels that would have been unimaginable 4 years ago. This resilience is built on the institutional floor. Firms like BlackRock manage ETF flows, providing constant liquidity. When prices dip towards $68,000, institutional rebalancing triggers automatic buy orders. These entities aren't speculating, they are maintaining fixed percentages in massive portfolios. Wealth managers like Morgan Stanley have fully integrated Bitcoin, treating it as a strategic long-term allocation. As institutions like Wells Fargo adopt the asset, a deeper buyer pool prevents retail-era freefalls. While Wall Street's entry capped the extreme upside, it also engineered a structural floor. The market has matured past the era of total collapse. However, this new stability comes with a shift in who actually controls the market's direction. Bitcoin no longer trades in isolation. Because it is held by the same institutions that own the S&P 500, it now behaves like a high-beta tech stock, frequently tracking the volatility of companies like NVIDIA. Price influence has shifted from miners to central bankers. The Federal Reserve is the new center of gravity. The price action is increasingly tied to the global M2 money supply. M2 is a measure of the total amount of money circulating in an economy. When liquidity is high and interest rates are low, Bitcoin thrives. When Jerome Powell and the Fed maintain restrictive rates, Bitcoin bleeds. Macro policy outweighs internal code. Wall Street's integration into the network has effectively shifted the drivers of its price. Global liquidity cycles, not mining rewards, are the new master cycle. The era of 100x annual returns has largely been replaced by a more measured growth phase. The volatility that once defined the asset is compressing. This diagram shows the shift. The extreme, jagged spikes of early cycles morph into a smoother, steadily rising wave. We're operating in a market with a lower ceiling due to diminishing returns, but a much higher floor provided by institutional demand. Bitcoin has graduated from its role as a retail speculative gamble. It is now a core component of the global macro-financial system. The 4-year cycle hasn't been destroyed, but it has mutated. It is now a longer, slower wave that moves in sync with the global economy. For the individual investor, this new reality requires a shift in how you measure success and risk. Ignoring Wall Street's influence can lead to inefficient capital allocation. The drivers of value have fundamentally moved. You must decide if you are chasing the ghost of the 2017 boom or if you are willing to accept the more stable, compounding returns of a maturing asset. Are we witnessing the final stabilization of a global reserve asset, or are we simply entering a longer, more complex market cycle? The map has changed. To navigate 2026 and the years beyond, investors must transition from speculators into macro-driven accumulators.